Hello and welcome to all Daily Hunt viewers to this very special series called Money View from the Top. I have a very special guest today, somebody who is a role model for millions of youth of this country, Radhika Gupta, who's the Managing Director and CEO at Edelweiss Asset Management and is also the Vice Chairperson of AMFI. Thank you very much, Radhika. It's always wonderful talking to you. And thank you for speaking to the viewers of Daily Hunt. A lot of young people consume this platform and are looking forward to hearing your views and seeing you. My first question, we saw a lot of new investors coming into the market over the last couple of years, both through mutual funds as well as through direct equity. And we'll talk about direct equity in just a bit. But even through mutual funds, and there is a sense of bearishness. There is a feeling that the sentiment has been hit. We do keep seeing, of course, days of bounce backs, sharp bounce backs. There's enormous volatility, bad news all around, war, inflation, economy. What would you tell these young people who have just started investing, listening to people like you, and going through their first real challenge, if I may say so?
So I think the meta point here for young people, and I do recognize, as you said, that so many of them have come into the markets via mutual funds or other equity market tools, is that what you're seeing in the markets is something that had to come. It was inevitable, right? I think ups and downs are part of the journey of equity investing. And while you probably started your journey and entered the market seeing a lot of ups and maybe 1.5 years of ups, this is also reality. And I think this reality will teach you how to be a better investor. It will teach you a little bit about your own sense of risk appetite. And if you can stay through the correction and come out of this period, I think you'll emerge a better investor. My own personal tryst with volatility as a professional, as an investor for the first time was 2008. And believe me, it felt much worse than this. I think the first time always feels bad. But every time there's a subsequent market correction, I always say, thank God I had 2008. And so I think if you get out of it, you'll be looking back and saying, thank God I had this.
Radhika, how do you view the recent set of interest rate hikes? I mean, we've just started, we had this big bang 40 basis point out of the blue, but the RBI governor has also gone on record to say, well, this is just the beginning. This is already playing out globally, and you've been a keen watcher of global markets as well. Again, inflation is not just an India problem. It's something happening in the developed world as well. From an investor's point of view, both in a debt instrument as well as in equity, how would you explain to them to tide over this current situation, and what could be the implications of this on their investments?
So I think one is that rate hikes, were going to happen because post-COVID, we lived in a period where money was essentially free, not just in India. And in India was not a zero-rate regime, but it was a low-rate regime. And globally, I think 70% of the world was at zero equivalent interest rates. So what you're seeing globally was going to happen. And the debate is only about the pace, the quantum, and the certainty around it. That's what makes markets nervous. It's not the fact that the event was going to happen. That the event was going to happen is known. As far as India and the RBI is concerned, now you can argue on when the RBI should have done it, but was an interest rate hike due to happen? It was due to happen because we can't be too far removed from what happens globally. And I think RBI chose to act in that what the market called a slightly surprise move because of their own reasons, perhaps because of the noise around inflation. So I think the short point is a rate hike is going to happen. Again, interest rates move in cycles. So that's something you have to keep in mind. Inflation is something that is a little more concerning. It's something that we see when we look at the results of companies. A quarter of results just happened, and it is something that hits the common man. And hopefully a series of steps are being taken, whether it's on the monetary side, like interest rates, or in other parts, to tackle inflation. But it is an issue, and I think it is an issue that occupies all central banks, and a lot of policymakers. I think from an investor's point of view, what does this mean? From a fixed income portfolio point of view, I would give you just very simple advice. Keep the money that you need in the short term, contingency money, what I call, in very, very short term kind of instruments that don't take large amounts of duration risk. So if there's money, Vivek, that you need in 3 months or 6 months, etc., keep it in very short term instruments like liquid funds. And at some point, because rates are rising, there will be money you want to park for the long term. You will get fantastic opportunities to invest fresh capital for 5 years, 10 years, 15 years. Just like when FD rates get higher, we all get excited, right? We don't mourn. You have equivalent mutual fund products that give you that kind of exposure. So barbell approach to fixed income, short-term money in very short-term instruments, long-term money, you will get opportunities to lock in very good rates for the long term.
A tendency that happens, Radhika, when interest rates go up is people start rushing to do the same old thing, right? To put their money in FDs. Do you see things changing? And again, what would be your advice to people that just because a bank is giving you 6% now instead of 5% doesn't mean that on a post-tax basis, it makes it a great investment opportunity?
Yeah, and I think people often forget the last line that you said, which is post-tax, right? On an FD, you pay a marginal rate of tax. And while I know I'm biased coming from the MF industry, do remember that when you invest in debt mutual funds today, Vivek, you pay a significantly lower rate of taxation, that is 20% over the prevailing rate of inflation. So that is called indexation. So if you're earning 8% on a debt mutual fund and inflation is what it is, 8 minus or 7 minus the rate of inflation, you'll probably end up paying about 10% tax. That is a pretty big difference. And today I should tell viewers, there are lots of products on the mutual fund platform. Bharat Bond ETF was the first example, but they're passive debt funds that give you the same FD-like experience with much lower tax rates.
Let's talk about the Bharat Bonds. It was a very unique thing that you were involved with. How has it played out over these last couple of years?
So I tell you, what the nicest thing about Bharat Bonds capital is it's been very sticky. I think we started with a plan that this would be a 10,000 crore program. It's a 45,500 crore program today. And if you just expand the net a little bit and look at what Bharat Bond created, which is an ecosystem of these passive debt funds, that's about 80,000 crores. So clearly this has gotten popular. I think investors have understood the story behind the program of passive debt funds, which is to give you predictability in debt investing. See, we are all simple people. We're fundamentally FD people. We like to walk into a bank and say, itne time mein itna milega. And that is what the structure like Bharat Bond did. So if you were investing in Bharat Bond 2030, you knew one thing. One, I have to keep my capital till 2030 and I'm not going to panic in the middle. And secondly, this is approximately the rate of interest I'm going to earn. I think that gives people a lot of comfort. And the nicest thing I've seen, Vivek, is that over the last year, of course, interest rates have moved up. Sometimes debt fund NAVs can be negative. There's no panic among Bharat Bond investors because they genuinely know I'm here till 2030. Why am I panicking? And that long-term orientation to debt investing, I think, has been fantastic. In fact, in this period of rising rates, investors have just come back and said, we want to add more.
Radhika, both in life and as well as in investing, you seem to have a very balanced approach, right? I mean, you run a very fast-growing fund. You're now the Vice Chairperson of AMFI, yet you've written a book. You have a huge following on various platforms because of your lessons of life that you keep putting out. So tell me one thing, from a investor's point of view who's sitting right now today in this volatile scenario, is today the time when a balanced fund might be the right way to start investing? I'm talking about someone who wants to invest today, not somebody who's already invested.
So, Vivek, I have always been a fan of balanced funds. Balanced advantage is the category where a significant part of my own money is parked, and it's one that I've talked about a lot. And there's a reason for it. I think for most of us, what we seek in our money is upside. India is growing, long-term markets are growing. We want to participate in the upside. But when you have those months where markets are down 30%, you can't deal with your portfolio being down 30%. So you want upside, but you want some downside protection. It sounds simple, but that I think is the promise that most of us see. And I think this asset class, and you want this without having to worry about Nifty is X today. Should I invest? Should I not invest? Should I redeem? Because we have lives to lead, right? We do all these things. I mean, you talked about all these things I do. I'm sure everyone on this call leads a very, very busy, on this, who's watching this leads a very busy life. So I think balanced advantage delivers on that promise. And that's why I advocate it. For first time investors, it's a great way to test out equity markets, to earn that return, to experience a little bit of volatility. And if you realize I can take on more risk, you can graduate up from a balanced advantage fund to some more risk taking. But it's a great way to make that jump from debt to equity in multiple steps. As I said, you don't go from a kid's pool to a diving pool, right? There are multiple steps in the middle of any journey. And I think this is the just right step. So I advocate it for a lot of investors. And as I said, I am personally a big investor myself.
You talked earlier about 2008, Radhika, and if we look at the foreign portfolio investors and their behavior, it almost reminds one of, again, going back to 2008, isn't it? Day after day, we see net selling. We've seen, I was reading today, something like close to 2 lakh crore has gone out in just this year. I know that it's nowhere near, the situation of 2008, but from an FPI outflow point of view, it seems pretty close up there, isn't it? Why do you think that is happening? And by when do you see them coming back?
So I see three things. One is that FPI selling in a period of rising rates is not a surprise, because as rates rise globally, they get opportunities in their home country. So that is not a surprise. That happens. It's happened in the past, it happens in the future. The second thing is, I think as ordinary Indian investors, we make a big hue and cry about FPI selling almost as if it's a personal attack on us. FPIs have their reasons for investing, which are often related to global mandates, which are related to India's positioning in the emerging markets index, etc. And FPI has his objectives. You and I have our own personal finance objectives. So to try and speculate what FPIs will do, I think is a tricky one. Third, you mentioned 2008. I think one thing that has increasingly changed from 2008 is that today you have a much stronger domestic institutional investor. Your SIP book into markets today is about 11 odd thousand crores. That wasn't the case. In fact, in the last 5 years, while FPIs have been net sellers, DIIs, thanks to retail money, have been net buyers. So I think that is one thing to keep in mind, that that, and I think that has made capital markets a lot more resilient today than maybe 5 years ago.
Radhika, 11,000, almost 12,000 crore, that's the kind of monthly SIP inflows. Do you see those coming down because of the recent, global and domestic economic inflation related issues? Or do you see from a very view from the top that this is a number, and many of you predicted 4 or 5 years ago when it was a number of 2,000-3,000 crores, that this is, bound to go only one way, and that is up. Where do you see this going, and do you see this continuing? I know there's been a lot of effort on investor education, and linked to this question is also the fact that you see a lot of young people today, and I started with this, over the last 2 years, opening their demat accounts on their own, trying to be stock pickers on their own. Crypto, that's a big thing with the young people. So do you think, as a mutual fund person, and of course, the vice chair of the association as well, do you think it's going to be more and more difficult for mutual funds to attract the younger people who are perhaps wrongly looking for quick returns?
Okay, so two parts. I think structurally, Vivek, SIPs will grow because there is a broader trend towards financialization of savings. And I think the awareness of SIPs is, I mean, I go and take flights and people will say, मैं mutual fund नहीं कर रहा, मैं SIP कर रहा हूँ. No, it's a different thing, that's not correct information. But, the awareness of something like an SIP, the fact that it's a habit, I think works for Indians, because ultimately most of us are salaried professionals and it builds a nice savings habit. And in fact, I think my book has a chapter that's a tribute to an SIP in life also, but it tells you that you can start very small and build up something very powerful. The SIP book, can it go through fluctuations? Of course it can. We saw that in the last correction. We saw that pre-COVID. But I think those fluctuations are 5 to 10%. So could the book decline by 5 to 10% because a little bit of froth goes away? Yes, it could. But will it long-term be structurally resilient? Absolutely. As far as comparisons to crypto and other instruments, I think it's an unfair comparison to the mutual fund industry. We represent a very transparent, highly regulated, time-tested asset class, or a product platform that has, by the way, a multitude of asset classes from fixed income to equity to commodity. There are always new flavors of the season that attract interest, but I think we've grown and prevailed over time. I hope that people realize that the promise of quick returns is often a very dangerous one. And more important than that, it is important to invest in regulated financial products. And that is, I've been very vocal on my feelings on crypto in social media, sometimes to a lot of flack. But my only belief is, one, invest in something regulated. Don't invest in something just because your neighbor has done it and it's made a lot of money and you don't understand what is going on. And third, please don't invest because some celebrity told you to invest. It's just not a very wise thing to do. I think that said, as a mutual fund industry, we always can find ways to make our product more appealing to young India. And that is a constant endeavor. So I believe there's something to learn from everyone in anything. The learning is let's keep making what we do more appealing to young India. But I like one of our ads, Vivek, in mutual funds, which you may have seen. Sachin's in that ad, and it says mutual funds hai, magic funds nahi hai. And I'm very proud that we as an industry are endorsing the fact that there is upside, but we can't do magic.
The problem, Radhika, which a lot of new investors perhaps face, and I don't know if you agree with that, is the big question of where do I start? I mean, you made a point about balanced advantage funds, but there are still so many categories. Within categories, there are so many schemes. There is so much of communication. And I think from a new investor point of view, there's a feeling that where do I start from? I mean, that's the kind of questions one hears from people who are beginning to invest. Do you believe that there is scope for more simplicity, for certain kind of simple products which are there for a beginner, and maybe more sophisticated categories for others? Do you believe, now that you've just taken over as the vice chairperson as well of AMFI, that as an industry, there is a scope to simplify things a little bit more?
I think there's always scope to get better. I don't think you need new products, by the way. So people keep saying, do you need new products for new investors, women investors, young investors? You don't. In fact, you need less products. I agree with you, Vivek. We have too many. There is a scope to perhaps, I think what we need to do is focus on mutual fund as a solution. So you've got all these pieces of Lego out there, right? You need to now tell someone, you're a 2-year-old, this is the Lego pieces that work for you, and this is what you can build with it. And hey, you're a 15-year-old, this is what works for you. And so for most investors, for instance, I say life, it doesn't matter how many categories we have, 2, 3 categories of equity and hybrid funds, and 2 categories of fixed income funds, 5 categories of funds, 1 to 2 funds per category, you are done. And I think that is the communication we need to have.
What are your fund managers telling you, Radhika, from a 3 to 5 year kind of a outlook? We hit 62,000 and there was a lot of euphoria. We're just going one way up after the sharp fall with the onset of COVID. And then, of course, things have sobered up a little. But from a 3 to 5 year point of view, what are your fund managers telling you? How bullish are they in terms of equity returns?
I think as fund managers, we never discuss market levels.
I'm not asking you for a market level. Yeah. I'm just saying from a sentiment or a returns point.
I think we discuss companies, Vivek, and I think we are medium-term bullish on the outlook of companies. We do believe India is coming off a long earnings low. And while there will be interim volatility and things like inflation, we are also at the beginning of a pickup in the capex cycle. The investment side of the economy will really start to kick in. So I think we are, medium-term bullish on the portfolios and companies and stories that we own. And as I said, in the fund management business, one, you never discuss market levels. Secondly, good fund managers, as I realized, are never over bullish or over bearish. I think kids fund management is about having a balanced head on your shoulders.
Okay, my final question to you. There are a lot of young women and men listening to this interview. Daily Hunt, what is your one piece of advice? I know that you have shared lots of your own life stories and learnings from it. Perhaps captured a lot of that in your book. What is the one piece of advice you would like to leave for them?
I think money advice is to get started in their journey early and learn along the way. Really, money is not that complicated, and men and women especially, because women don't do enough of this. Get started early. Make mistakes just such as you will make mistakes in life and your career. Realize that it's okay, and then figure out what works for you. I think in that sense, money and life are the same. It's important to get a start, not worry too much about failure, and then keep going along.
Thank you very much, Radhika Gupta. I wish you all the very best. Keep inspiring, and thank you for joining us here. Look forward to many more conversations with you. Thank you.
Thank you, Vivek.